Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. And it seems like I was just here. Oh, it's mind-boggling how fast time goes by. And I was just reading in the Wall Street Journal today, the Fed's talking about raising interest rates sometime soon, sooner than previously forecast. And they're talking about raising them to 0.6%. So just for you non-math majors or math-related people out there that don't have to do that anymore, I can't imagine if I didn't have to do this, it'd be pretty tough. Anyway, so 0.6% is not a lot of money, if you didn't know that. Multiply the number by 0.0006. Did I put too many zeros in there? Anyway, it's a small amount of money, very small amount of money. On $1 million, that's $6,000 a year. $1 million bucks, and you get $6,000. Woohoo! Let's run out and let's buy bonds. No. And that's one of the reasons that we've been talking about alternatives on this show for the last, probably the last 2 years now. Some stuff that's out there. We'll talk about that a little bit later in today's show. In fact, what I'm going to do is from now on, the first 20 minutes of the show, I'm going to talk about, actually the first 15 minutes of the show, I'm going to talk about the economy, what's going on, what's interesting out there, what's going to push growth forward, because there is a lot. I mean, it's a lot. There are plenty of projects to keep America and all the other countries in the world busy long after I'm gone. So long after, it's not like we can't improve, and it's not like they're not trying, because somebody who, that's the nature of competition. Competition is tough, it's brutal, but it's how things are, how things progress. We're competing with the Chinese. They landed on, was it Mars? Yeah, it was Mars. Just a couple weeks after we did. And they've got computers, these quantum computers, that are faster than ours. And so they're pulling ahead of us in some areas, and we'll close that gap. I don't doubt it at all. But that's the nature of the beast. So competition keeps things moving forward, and we're going to keep moving forward. There's no doubt about that. And it's going. It's coming and going. So that's what I'm going to do from now on. The first 20 minutes, I'm going to talk a little bit about the economy, things that I see, things that could have impact on financial markets. Then the second portion, we're going to talk about what you do today to generate income from your portfolios. I'm going to specialize in that because so many people, the fastest growing segment of the population is 60 and over. Google it if you don't believe it. Fastest growing section of the population is 60 and over. Every day, 10,000 people turn 60. Every day, 10,000 people are turning 60. So, and when you're getting close to retirement age, one of the things that's really important is being able to generate sources of income so that you can keep living, or at least you can eat while you're living. And that's kind of important. So I'm going to spend some time talking about that. It'll be the second segment. The third segment, I'm going to talk about individual stocks. You know why? Because I like it. That's the only reason. It's because I like talking about stocks. I have a portion of my money. It's actually a pretty good portion now because it's actually done well, and I didn't do what I normally do. I didn't take the profits and move it over into my more conservative money this year. I just left it where it was, and I'm going to run with that for a while, see how that goes. But It can be fun. It can be dangerous if you don't know what you're doing. It can be dangerous even if you do know what you're doing, but you forget to, I guess, put a kind of you got to stick to the rules, basically. And I'll tell you what those rules are. Actually, they're published on a website called Look Out for the Bull. I'm going to put a couple of variations out there this year because there are certain things you cannot not do when you're investing in individual stocks or trading. This is longer term trading. This is not day trading. We're not looking for 3 to 5 day holding periods. I want the money like when I bought Tesla, when it came up on my scan, it had already been up a lot, and then it went up a whole lot more. And then when I got stopped out of it, I wasn't upset that because it kept dropping. By the way, that always makes you feel kind of good. I sold it, and it's still going down. But anyway, it turned around and went up after that point. And at that point, I didn't have that much interest in it because I felt like the majority of the move was over. And you know what? I was right. The majority of the move was over. Is it going to run again? I don't know. Can it run as far as it did that when I bought it? I doubt it. The valuation was a lot lower when I bought it than it is today. And valuations in the long run, they matter. In the long run, they're the only thing that matters, almost. And I was reading some of Warren Buffett stuff. I'm getting off on a tangent here. But anyway, the third section of each show, we're going to talk about individual stocks because I like doing it. It's fun. There's the Look Out for the Bull. It's fun if you do it the way I do it. But I can tell you, it's not always fun. It's a lot like baseball. It reminds me of what it must be like to be a major league designated hitter. Major league designated hitter knows he's going to strike out around 7 out of 10 times because all baseball players strike out around 7 out of 10 times, at least the good ones. The bad ones, they strike out 8.5 times out of 10. And they're not bad. I mean, to get to that level, you got to have some big time talent. But anyway, 3 out of 7. That will make you a multi-millionaire in a Major League Baseball. Multi-millionaire. You can be a 300 hitter. Yeah, you're going to go down in the Hall of Fame. Thinking about that. You're striking out 7 out of 10 times. And I just think that psychologically, those guys, I know they're extremely tough, or they've got an ability just to concentrate and forget what happened on the last pitch. I'm sure of that. And that's what you need to do if you're going to be a longer-term trader in stocks. Forget the last stock. Don't even think about them. When they're over, they're over. Okay? You have to concentrate on what's going on right now. Concentrate on looking at that next big fat pitch. That's what you're doing. You're trying to look for anyway. I'm using all these analogies. I'm boring myself now. So anyway, that's the third part of each show. We're going to talk about that. So getting back to the economy, what is going to push the economy forward? How are we going to grow out of this? How are we going to grow out of the debt? That's going to a couple of things. They're not going to raise interest rates a lot, by the way. They will not raise interest rates a ton. I can't guarantee that. But if I owed $30 trillion and I got to pick my own interest rate, I don't think I'd be raising my interest rate all that much. It's because, you have to pay that interest. The government has to pay interest on that. And, it's a lot of debt. So the bottom line is even if they creep up, even if they went to 1 or 2%, can you really live on 1 or 2%? Is that easy to do? I don't think so. 1% of $1 million is $10,000. Think about that for a second. 1% of $1 million is $10,000. You got $1 million in treasuries. Now the rate's up to 1%, and you're getting $10,000. And oh, by the way, you get to pay taxes on that $10,000. So, this is a tough time. This is really tough. And if it weren't for the growth in the economy worldwide, it's not just in America, worldwide, and I'd probably be a lot more upset than I am right now. And actually, I'm not upset at all because the growth is there, and we are taking steps. We're moving. We're progressing. The amount of money. One of the issues is going to be, and if interest rates do in fact start to go higher, it's going to be because we don't have enough workers to do all the work that's necessary. We don't have the skilled workers in particular. Kids have got to get training. If you've got a child that's growing up or is in high school, doesn't have a lot of interest in college, I'm telling you what, sign them up to be an electrician. Everything's going electric. The cars, our houses are mostly electric now. It's the easiest thing to do. And those guys, they're going to be a bunch of millionaires walking around, driving trucks, going in buildings and wiring trenches, I would hate to be the guy climbing up on those. I have a slight fear of heights. So I don't want to be working up there like that, but somebody's got to do that. And they make a pretty good buck. So if I were absolutely. I would send any of the trades, actually, just because of the building that's going to go on and has continued to go on, all the remodeling that's going on. Any of the trades, they're fine. Actually, they're probably going to make more money relative to what the economy did in the past or what other categories did. They're probably going to make more money relative to those other industries than they ever have. So that's a concern out there that you could have. Back in the 70s, you had wages going up because inflation was going up, and then they would raise prices to be able to pay the higher wages, and call it a spiraling effect. We're not anywhere near there right now. Actually, it looks like we've started to move maybe a little bit in that direction. We'll see what happens. Yeah, if inflation really does pick up a lot, then they will actually be able to afford to raise interest rates. You might see a 4 to 5% CD again somewhere in the next 10 to 15 years. So if you're in your 60s, I'm not sure that would be something you would want to wait for. That's a long time to be without a high interest rate. Just getting 1 or 2%. And that's a very long time. And that's where the fixed income products come in today. So, and getting back to stocks, if you look at valuations, the larger the companies are, the more overvalued they get in a lot of cases. I mean, actually, that's across the board for a lot of things. But they're not obscenely overpriced, which is very comforting to someone like me, because I'm looking around going, hey, if we have a down year, 1 or 2 years, and that's fine. I can put up with that, just as long as I know it's not going to be 10 or 15. And by the way, you never really know if it's not going to be 10 or 15 because you don't know what's going to happen exactly. Just given where the level of stocks are relative to the business that the stocks are doing, it's ahead of itself. There's no doubt. But it's not like it was it's not like the tech stocks were in the late 90s. It's not even close to that. It's nearly a quarter of that. That's why I'm relaxed. So do I think stocks are a good place to invest? Absolutely. How much should I put in my portfolio? Depends on your age. Depends on how much money you need to take out. That's going to determine that. And unfortunately, there's no one easy rule for that because everybody's lives are different. Everybody's lives are different. That's what cracks me up about all these magazines and all these financial publications. Here's the one rule. Yeah, right. What planet are you from? Yeah, I have not been, or where do you have your head buried? Because if you talked to individuals, you'd know better than to write that. And I know why they do it, because that's actually what everybody wants. We all want that one surefire thing that's going to bring us all home and save the day. Well, it doesn't actually work like that in most cases. When I say most cases, I mean probably 99.9999% of the cases. And there is an extremely small percentage of the cases where somebody bets it all on one thing, makes a huge amount of money, sells it, and puts it in a bank account and lives happily ever after. Now, there are more lottery winners than there are those people. So I don't rely on luck. I try not to rely on luck as much as possible. And just plain logic. Let's look at the numbers. Let's see where we're at. What are the best courses that we might be able to take given our own set of circumstances? And how much risk do we think we can handle? That's a big deal. How much risk do you think you can handle? In fact, I've been talking about this my entire career. Well, I shouldn't say my entire career. It took me a few years to figure this out. So, and what I'm about to tell you is, and I think I'm actually going to have to wait until after the commercial break to finish this. But anyway, here's a real quick question for you. How much of a decline in your portfolio, let's say all your retirement savings, how much of a decline are you really comfortable sitting through in order to increase the rate of return you're going to get on your investments? How much of a decline would you be willing to sit through if it meant making more money is really what I'm really saying. And that's the key. That's what you use to gauge how much money you're going to have in stocks versus the bonds that are paying less than 1% right now, but maybe will be paying 1% in a year or two from now. It's the breakdown between the stocks and the fixed income that's going to determine how much that fluctuates. Because trying to forecast what's going to happen over the next 6, 12, 14, 24, even 5 years, you might as well toss a quarter. Those are what your chances are. You're either going to be right or you're going to be wrong. And there's a 50-50 shot. I don't even think it's 50-50, but now that I hear the music, I got to take a commercial break. I'll swing that a little bit later. You're listening to Bill Bullington. Stay tuned. I'll be right back.
Out in the rain, feel so alone, feel so afraid. I heard you pray in Jesus' name. It may be midnight or midday. It's never early, never late. He gon' stand by what he claimed. I lived enough life to save. Help is on the way, round in the corner. Help is on the way, coming for you. Help. In the dark and all alone, growing comfortable. Are you too scared to move and walk out of this tomb? Buried underneath the lies that you believed, safe and sound, stuck in the ground, too lost to be found. You're just asleep, and it's time to leave. Come on and rise up, take a breath, you're alive now. Can't you hear the voice of Jesus calling us out from
And we're back. Hey, my name is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can get a copy of this on the Fishes podcast, 955thefish.com. You can also go to my website, bullingtoncapital.com. It's hosted there by iHeart. iHeart's one of the biggest, I think it is the largest blog platform in the world, if I'm not mistaken. And by the way, little hint at what's coming a little bit later. iHeart Media, the one where you can go and just type in Bullington Capital and you'll hear this show. The symbol is IHRT. The stock symbol, it's publicly traded. It closed yesterday at $25.35. And it came up on my scan. So that was pretty cool. And we'll talk about how those things come up in the last segment of today's show, and a bunch of other ones that came up. And so that should be really interesting. I'm always fascinated. I have learned more about the world and how it operates by looking at stocks, reading about what they do, how they do it, reading the quarterly messages from the CEOs. It's been unbelievably beneficial on an educational level for how the rest of the world works. It's mind-boggling. So it's been, I feel very privileged to have been able to spend the kind of time I get to spend studying this stuff. It's because it is fascinating, actually. And anyway, so I'm going to spend the next few minutes just talking about fixed or current rates that you can get guaranteed by insurance companies, and typically with various annuities. And by the way, the annuities have there are lots of different annuities. I mean, there are literally thousands of them, literally thousands. And so when you're talking about them, to lump them all together, it always kills me when somebody does that. They lump it all together. I'm like, all right, okay. Do you know what the difference between a Cessna and a 747 is? They're both airplanes, right? So if you said all airplanes are light and can get blown out of the sky by a tornado, you would not be correct. That is a horrible analogy, but anyway, I hope you get my point. There are different types of planes. There are different types of cars. Or how about this? Automobiles. You're going to call it, well, what are you going to get? I'm going to get an automobile. No, you're not. You're going to get a Ford. You're going to get a Range Rover if you want to waste a lot of money. Just kidding. But you're not going to get a car. You're going to get a specific type of car because they're all, well, there's a lot of different models out there, a lot of choices. There are a lot of annuities like that. So the ones that I'm really interested in today are to help out in the area of fixed income, that area where you want to know what you're going to get. Okay, now the guarantees that you get on that, the guarantees that are going to be guaranteed by an insurance company, are only as strong as the insurance company that's making the guarantee. So you got to be careful there. You want to make sure you're picking strong companies. A+ rated, AM Best is one of the first things that you want to look for. And if it's not, I don't know, you're increasing risk if you don't do that. But that being said, these types of products will guarantee an income over your lifetime. And the one I like the most in that category is the one that guarantees an income because it's pretty high. And for every year that you don't take the income, they'll increase the amount of income that you could get by 7%. They'll guarantee that for 10 years. That's pretty cool. I really like that. I like the rates, the different rates that they're paying out. They're different insurance companies, by the way, they love to call these things different names. There's a payout percentage. That's what some of them use. That's what I'm going to use. That would be the dollar amount that you could get based on the amount that you put into it. And I'm going to, actually, my computer just timed out here. I was going to put in an example for you, but now I'm going to have to wait until I can get back on the internet. Oh, well. It was somewhere around I think if you started off at $100,000 and you were 10 years away from retirement, the income benefit base, that's not the cash value of the investments. That's the number that they're going to use to determine what your payout's going to be. I'm trying to think. I think it was around $1,000 a month. Yeah. So on $100,000, 10 years from now, I could get $1,000 a month from it. That's pretty good. You know what? Over a year's time, that's it's almost $12,000. If you look at what a CD is going to do over that time period, or what government bonds are going to do, or even what corporate bonds paying 1.5%, it's not even close. It's not remotely close. So, and that's the only reason I'm looking at these now. It's for the guaranteed portion of the contracts. Yes, they have investments that you're going to put your money in. They have a chance to grow faster than the rate of return that they've guaranteed. I just don't think it's a good one, personally. That's my opinion. Okay, I'd be tickled pink if the investments outperformed the guarantees because I bought it just for the guarantee. That's why I got it, because I like the guarantees on it. And if you want to, actually, you can email me. Go to my website, bullingtoncapital.com, or just you can email me, bill@bullingtoncapital. And I can send you a link to a website where you can go in and you can put your age and you can put the kind of assets you have, and it'll show you what kind of income you could generate. Or you could say, hey, I would like to have this amount of income guaranteed for my lifetime. This is when I want to take it. How much money do I need? And it'll do the calculation for you. So either way, and it also explains a lot about the investment options that are available there. Again, I'm just kind of focusing on the fixed income because bonds are so low. And by the way, when they start raising interest rates, do you know what happens to most bonds? They go down. So if you're buying 30-year government bonds because they're paying more than a 1-year government bond is, and they start raising interest rates, the principal on your bond may go down. In fact, it most probably will. The likelihood of it going down in price at some point in time is about the same likelihood that the Browns don't go undefeated next year. And maybe the Browns will go undefeated. There's a chance. It ain't a good one. And it's the same way with bond prices not going down if interest rates go up. I mean, there is a chance. It's not a good one. So anyway, when you're looking at that's the other reason that I was looking at this, kind of as a substitute for the fixed income in your portfolios. The fixed income rates are much higher. Now, I'm going to leave that alone. Again, if you want to learn more about it, just hit me up, send me an email. I'll send you a link, or you can call, set up a phone appointment. And right-hand person there is Melissa King and Gary Miller, and then either one of them can put you on my calendar, and you can talk more about that. The other thing I wanted to talk about was it's another type of annuity. It's relatively new. It hasn't been around for hundreds of years like the other ones have. I'm pretty sure this one's only been around for about 10 or 15 years. I can't remember. But anyway, it's called an investment-only annuity. Investment-only annuity. You don't have a sales charge going in. You don't have a sales charge going out. There's no holding period, no penalty. You can put the money in, take it out as you want. They also have a bunch of options. If you wanted to guarantee that your beneficiaries would inherit a certain amount, they have guarantees for that. You can add that to the contract. You can add an income benefit to the contract. That's pretty cool. Then you can take it off if you want. So I like to call it the Gumby annuity because it's so flexible. You can keep changing it around if you want to. Now, it's probably not a good idea to go in with the idea of, well, I'm going to change this every other year. That's not so. Unless you're managing the funds within it. There are over 300 funds, Vanguard, Fidelity, T. Rowe Price, you name it, it's in there. Kind of reminds me of those old Prego television commercials. It's in there. But you can move within the annuity and not generate a taxable event. So you can rebalance your portfolio. You don't get any 1099s until you start to take the money out. So that's cool. Tax deferred. And it doesn't have a limit like a non-deductible IRA. It's tax deferred too. If you don't qualify to be able to make a contribution to an IRA, oftentimes you can do a non-deductible IRA, but not all times. But with these, you don't have to qualify at all. You're not going to get the deduction the first year, but all that growth, you don't have to worry about capital gains or dividends. When you do start taking money out, however you start taking it out, you could set it up on what's called a systematic withdrawal. You could take advantage of the income riders that you've added to it that will guarantee a certain amount of income. That's the one that I really like a lot. It's not as high as the fixed indexed annuities. Why? Well, because these guys are going to let you put up to 100% of your money in the stock funds in that portfolio. They'll still guarantee an income over the rest of your life, but you're going to get the growth on 100% stock funds. That's amazing. And that is missed by 99 out of 100 people who invest in this product. They miss that point. They're not paying attention. And it's why I'm taking this tone of voice. Listen up. It's a big deal when a company lets you put 100% of your money into stock funds, lets you manage the money, move the money around, and they're still going to guarantee that we'll give you 4% a year for an individual, 3.75 if you're a couple. They will guarantee that no matter how poorly you manage that money, if you manage it poorly, they're still going to guarantee that you can get those rates no matter what happens in the stock market, no matter how many bad decisions you make. That's pretty cool. That's taking on an awful lot of risk. Incidentally, that's why the rate is slightly lower. Is because they're allowing you to do this kind of stuff to invest 100%, and they're still going to guarantee the income. So they've got to take it down a notch or two. And, if you make more than that, and then this is what is really good about this. let's say you're a good manager, or you hire somebody to help you. I like to use a momentum model inside those contracts. They've done very well so far, knock on wood. And if the value goes up on the anniversary date, by the way, is 1 year after you've invested in it. If the value goes up, your income goes up. Think about that for a second. Now, the one that we talked about 5 minutes ago had a higher interest rate to begin with than this one does, but no chance for growth. It's higher, and it's going to stay fixed. They'll keep paying until you pass away or cash it in, whatever you want to do. But the rate's higher, but it's higher because it's going to remain fixed. This one's a little lower because it has the opportunity to go higher. So when you're talking about inflation, and inflation's already been ensuing, the chances of inflation going away anytime soon are about as good as me winning last week's lottery that I didn't buy tickets for. I would have to find one in the parking lot that was winning. There's still a chance. That's really not a good chance. And that's kind of what I'm talking about here. So you've got, let's just review this for a second. You've got all these mutual funds. There are tons of mutual funds in there, and there's no 1099 until you start to take money out. You have the ability to take money out. That will affect the income benefit base. That I'll have to come back to that on the next show. That one's too complicated to tackle today, but I will. If it goes way up, the income's going to go up. If it goes way up and then it drops like a rock again, it doesn't matter. They're guaranteeing that higher income rate for as long as you live. So because it has a chance to go higher during your lifetime, and I'm going to tell you that, if your life expectancy is at least 10 or 20 years, there's a pretty good chance stocks are going to be higher and the income on that product is going to increase over time. There's a pretty good chance that will happen. So, and again, this one has no penalties or commissions in or out. Okay? There's no penalties, no commissions. So it's a balancing act. What would you like to do? I think between those, you could actually solve all your investment problems. One of them is going to give you a fixed rate that's higher, but it's going to stay fixed. The other one's going to start out lower. Hopefully, market continues to go and you live long enough, that will move up over time and keep up with inflation, because I can promise you this, inflation won't retire when you do. Inflation will not retire when you do. So that one's there for some inflation protection. And again, it's extremely flexible. If you get to the point where you've got so much money, you say, I don't need those guarantees anymore. Well, great. Take it off there and you stop paying for it. It's 0.5%, by the way, 1/2 for that income guarantee. That's a really good product. Now, I know you're probably don't ever try to write this down while you're driving. Just go to my website and hit me up. I'll try to call you back as quickly as I can. And I can send you out information. You can set up a phone call to talk about it. You can come into the office. Whatever you'd like to do. But these are important items to have today. And I'm very thankful to be able to have access to them. That wasn't always that way in my industry. So I think they're very good for what is going on right now in the economy. And again, so this is the painful 15-minute section of today's show that the young people that want to talk about stocks, and not just young people, by the way, but a lot of people want to talk about stocks. That's coming up right after the very next commercial break. So we're going to talk about where I started this whole thing, my roots, getting back to the stock market and explaining what I'm seeing now, what's moving now. How far do you think that can go? Nobody really knows that, by the way. But when you look at the valuations on some of these stocks, I'm pleased, very pleased, because I feel like there's room for continued upside. And we'll talk about some specific areas. I'll talk about some specific names. And eventually, hopefully, I think we've got a couple of, it's just been a kind of hard, investment clubs that want to get together and talk about this stuff in more detail. And we are definitely going to shoot to get that done by August of this year, which is coming up really quickly. Anyway, I hear the music. I got to take a real quick commercial break. This is Bill Bullington right here on 1420. Stay tuned. I will be right back.
Time, and where does it go? How can I stop my life from passing me by? I don't know. I've been thinking about family, now it's going so fast. Will I wake up one morning just wishing that I could go back? I've been thinking that I thought would never end, trying to make it on faith in a struggle against the wind. I've seen the dark and the broken places, oh, but I know in my soul, no matter how bad it gets, I'll be alright. There's hope in front of me, but there's a light, I still see it. There's a hand still holding me.
And I hope you listen to those words on that song. Yeah, because it is very appropriate for today. And there is a lot of light. There's a lot of light. I see a lot of really good things. As I'm reading the headlines, you have to remember, by the way, bad news gets more attention than good news does. It just, the way we're wired as human beings. And so when you see headlines, they're typically going to have a little negative tint to them. Lumber prices are falling fast, turning hoarders into sellers. So that's a problem. You know what was a problem 6 months ago? Lumber prices are going up really fast, so you better get it now. A lot of things are how you look at them, by the way. And I think lumber prices coming down, that makes me relax a little bit. Even if it does, even if the value of your home dropped a little bit over time, you're not going to sell your home because the price goes down a couple $1,000. That's not going to happen. And over the next 10, 15 years, the way the Fed's printed up all this money, that real estate's probably going to do fairly well over that time period. So anyway, I'm going to leave that behind and go on to the stock portion of today's show. Now, every week, I'm going to do this now. The last 15 minutes, just going to be dedicated to stocks. This is something that I really like to do. It used to be what I did, how I managed most of the money, but I got way too large for that, and the market moves too quickly. So I'm bringing this service out as a, I don't know what I would call it, maybe to kind of try to make up for the fact that I can't do this on an individual basis like I used to, because stocks just move too quickly. And you can't, when you're managing a whole bunch of accounts, it's really hard to do. And the vast majority of people are not built for this. I'm going to tell you right now, it's fun to talk about. It's interesting, but the vast majority of people just don't have the kind of time it takes. And more often than not, even if they do have the kind of time it takes, they don't have the temperament, because nobody's telling them how it really works and what the challenges are. You know, they're telling them what they want to hear, in other words. And that's why that whole website, Look Out for the Bull, that's where that came from. Look Out for the Bull. There's just a lot of stuff out there that's there to sell ads, not to help you make money. It's there to sell ads. And if you knew anything about journalism, you'd know all about that. So I'm going to leave that alone. But anyway, so I do these scans. I do them on a daily basis. And this is where I buy the stocks for that portion of my money. And it's only about 25% of my total. If I lost the whole thing, it wouldn't impact my life. And the chances of me losing the whole thing are almost as good as the Browns going undefeated. Think about that for a second. The chances of me losing the whole thing are about as good as the Browns going undefeated. There's not a good chance. Now I hope the Browns do go undefeated. And believe me, I love their quarterback. They got a nice coaching staff, good players, good team. They got a great team. But to go undefeated is really hard to do. I don't care how good your team is. To make it through an entire season undefeated is extremely rare. So winning on more than 50% of your transactions, if you are trading, is extremely rare, unless you're front running and the day trading kind of stuff you can't do anymore because you're competing with computers. And it was hard even when it was easy anyway. And all these ads and stuff that talked about the 80% winning trades. Yeah, I bought a ton of those things, and I tested them all out. And I'm telling you, the reality, here's the reality. If you make money on 30 or 40% of your transactions and you cut your losses quickly enough, you can make money. That's all you need to do. That's why I was saying it's more like a Major League Baseball player. A 300 batting average is enough to make a lot of money. A lot of money. It's all in your mindset. How quickly do you cut your losses? How patient are you with your winners? Yeah, there's got to be a certain amount of patience there. So, again, we'll continue to talk about this. Look out for the Bull website is up. It publishes the list of the scans that I use, and then I narrow that list down. So here's what I narrowed that list down to over the week. And I'm not going to talk about all the companies. I'm going to talk about a few of them. One of them was CBOE. That's where they used to trade all the futures, and they had pits, futures pits, interest rate futures, all kinds of different types of financial instruments there. It's in Chicago. Well, now it's all computerized, right? Or 99% computerized. And this company it's publicly traded. Now, the chances of that company going away anytime soon, not very likely. Okay, so it comes up on a scan. What does that mean to me? Well, what that means to me is I'm going to probably take a little position in it, not a big one because it's not actually. Yeah, I'm even gonna pass on this one because I have some others that I like better than this, and I'm fully invested right now. But when I look at the chart, it met all the criteria that I need it to meet. The day before yesterday, it went up a little over 2%, closed near the high of the day. It's been in the top 10% of all stocks over the last 90 days. So if you were looking at if this were a horse on a racetrack, they would be about a third of the way through and be out in front. Does that mean it's going to win? Nope. Just means it's out in front right now. So I think I'm going to have to work on my analogies. Oh, well. So anyway, CBOE, it was recognizable. It's done very well since it first became a public entity. I mean, incredibly well. The stock's $116 right now, and it was down under 20. It got down to, at one point in time. The first year it came public, they do like a lot of public companies do. They come public and they drop, like a rock. And I know that probably shocks a lot of people. Oh, I know these publicly traded, they go up right away. No, they don't. The vast majority of them go down before they start going up. If it's a good company, then they'll go up. And there are a bunch of reasons for that. Maybe we'll get into that next week. Anyway, CBOE is okay. There are a bunch of biotech companies. Some of them didn't even have sales. And if the valuation's super, super high, I tend to pass on it. But there are a ton of technology stocks coming in. There's a Home Trust Bank shares, HTBI is its symbol. The valuation on it is slightly low, which I really like a lot. If you have a lower valuation, and it's got more room to run. But oftentimes the stocks don't care. You look at a whole bunch of companies, the price movement alone will attract other investors into those stocks. And it's like a self-fulfilling prophecy. Now, at some point in time, it's like musical chairs. The music's going to stop. Okay? When it stops, got to go. And you're not going to stop at the top. You won't pick that. It'll already have started down before you got out of it. But we'll talk about this in more detail next week. But I just wanted to mention, too, iHeartRadio has shown up. I think that's a pretty interesting. Joann Fabrics, JOAN, showed up. And it's got a relatively low valuation, which is good. They just came public again. I don't know if they were spun off. What happened? I didn't have time to look that up. But I can tell you that Joann Fabrics been around for a long time. When I'm looking at the valuation and the fact that it comes up on a momentum scan, that means it's moving up pretty quickly. It's in the top 10%. Well, all right, I'm interested in that. I'll take a look at it. And if I get stopped out of it once or twice, that's okay. That's another thing we'll go into in more detail down the road. It's called getting stopped out. This is when you're going to be investing this way. You're actually going to put a stop. I'm going to cut my loss. And typically I use 10%, somewhere between 10 and 20% of whatever my purchase price is. I like to use 10 personally on the initial stop. Okay, and that's what I would do with that stock. If it gets hit, then great, I'm out. If I've got my position down to 5% of that account value, that's 0.5%. That's why I can be so casual when I talk about this stuff. I have 5% of my money, which, by the way, from an institutional standpoint is insane. They never put 5% of their money in anything. Nothing. That's in a hugely. In fact, most of the big funds would have to get approval from the SEC before they did something like that. So anyway, and that's one of the advantages that we have as smaller investors. You can put 5% in, no sweat. And again, by the way, don't confuse this with investing. People do that all the time. This is not investing. This is trading. They are two different things. There's investing, there's trading, and then there's gambling. A lot of people are gamblers. They just don't know it. Okay? You've got your hardcore traders, those guys that know what they're doing, managing their risk all the time. Then you have the investors, guys like Warren Buffett, that are looking at businesses, and they're not. There was a recent video up on YouTube. Recent to me. I saw Warren Buffett talking about it and talking about how long stocks can stay sideways or negative. Decades sometimes. And that's his style. That's one of the reasons he's so good at it, is because he's got the temperament for it. And he talks about that too. You buy really high quality companies. What's the definition of high quality? High quality is a company that earns a big profit, has a big fat profit margin, and finds ways to grow their sales. That's a high quality company. As a water boy would say, that's high quality. Don't know if you've seen that movie. Anyway, now you know why I have to be a financial advisor for a living. Never make it as an entertainer. That's okay. Kulik & Sofa, by the way, came up. KLIC. And it doesn't have a super high price to sales ratio. It's not super low, but it's one of my favorite stocks in the semiconductor space. So I just thought I would mention it. McAfee. Now this is interesting. This is the software company. It just came public. It hasn't been public for very long. The valuation on it's not really that high. It's very low relative to other software companies. So you got a company that looks good on a valuation basis, and you got a company that a lot of people know of. McAfee, when you turn your computers on, you probably see their little thing pop up. It's to protect you from a lot of the malaise that goes on in the internet, or at least to try to help protect your software from being taken over by somebody who wants to demand a whole lot of money for it. And wow, a reasonable valuation and a brand name that's got to be worth a lot. And I think it comes up on a momentum scan. So by the way, the symbol for that is MCFE. And let me get back to that. The prices I'm talking about is $28.93, about $29. And last one I'll talk about is Oppenheimer. Now, by the way, these just came up, so I don't actually own any of these yet. Okay, and I reserve the right to invest in them tomorrow or by the end of today, which is Friday. By the way, I'm pre-recording. So Oppenheimer's OPY. Radnet. This is a good-looking chart. I do own this one, by the way, RDNT. Oh, no, I can't believe I ran out of time. Well, anyway, we'll carry this conversation on. And if you hear something that you want more information on, feel free to hit me up on my email. Go to my website, bullingtoncapital.com. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.